Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. How are you, sir?
I am doing well, Jared. Thank you for asking.
Great
How are
to
you
hear.
today?
Doing great. I know you're not too far on the other side of town. There was a crazy storm that came through last night. Did you see any of that?
I did, and the rooster held up well on the roof.
Good.
The cupola. Pretty
Good.
happy about that.
That's awesome. That's awesome. Well, we survived, and we're in pack mode. We're getting all of our bags packed up. We're going to take the missus and the three little ones. We're going to do a little road trip along the Northeast and go have some fun, a little early summer vacation.
That's going to be awesome. You're telling me a little bit about that adventure. I think you're going to have a great time. Good for you, Jared.
I'm excited.
I'm jealous. I'm not going.
Next time.
Yeah, thanks.
Well, so last time when we were talking about really all the different types of term insurance and how that can fill the gap for the various types of people, where that might fit, what the different types are out there. I know we talked a little bit about, just regular run-of-the-mill term, some convertible term, and then we broke into how whole life, even though it seems to be to the common man the most expensive because the premiums are the highest, it is indeed the cheapest if you look at it from the long term. So yes. Kind of there's the quick recap from the last time, but given that we just rolled off of, a little bit of discussion about term insurance and some of the different applications, I wanted to build on that just a little bit more and maybe just discuss what the application would be for us. What would be a scenario when you would use term insurance when someone comes to you and says, "Hey, John, I'm very interested. I've read the book. I understand what Nelson Nash is saying, and I'd like to learn a little bit more." When would term come up in the discussion when you're talking with a new client?
All right. Well, as IBC practitioners, when you build these things, when you build a life insurance contract to be used as a banking policy, you are restricted by the MEC. And there's been a lot of discussion out there. The level of awareness of what a modified endowment contract is covers the gamut. So it might be instructive just to talk briefly about that.
Perfect.
And really what the modified endowment contract is, it's just a tax treatment of a life insurance policy, not a dividend, but a cash value life insurance contract.
Sure.
And it has quite a colorful history, and I would probably bore people to tears if I went into that history. So suffice it to say, for the sake of our discussion here, that it looks at the amount of money the amount of cash that you put into a contract over a 7-year period. The IRS has determined that there must be a 7-year test, a 7-year rule they call it, on life insurance contracts that are cash value. And so they look at the average cost. What does it cost for life insurance with various carriers to provide X number of dollars of death benefit for each dollar? After they look at that equation, they come up with a factor. That number is plugged into your life insurance illustration, and it'll tell you whether it's a MEC or not. And if it is a MEC, then we have other things we've got to deal with. That means we're putting too much cash into a contract for the amount of death benefit. Well, how do you get around that?
So what you're saying is that the IRS thought that whole life insurance was such a great place to put money that they had to limit the amount that you could put into it. Is that correct?
Yeah, they actually passed two pieces of legislation
that was in jest, but it's true.
Yeah. No, there's two specific pieces of acts of Congress to address this, to go after this money, and probably going beyond the scope of this conversation. DARPA and TARPA and TAMRA. There's actually three of them actually, but I won't go into those. But
so if I can sum it up and tell me if I'm oversimplifying this, if you decided to get a insurance policy of which the cost of insurance was $100 per year over the course of 7 years.
Yes.
And then at the end of 7 years, if I put in more than $700, I would potentially be considering that policy as a mech.
Yes, that's correct.
Correct, because it's based on the cost of insurance.
Right. And so, but they look at the death benefit. So
That's
there's
right.
a ratio of cash value to death benefit. And if you compress it to the point where that cash value exceeds that threshold to death benefit ratio, you
Yep.
have become a mech. And once a mech, always a mech. And
Once a
that is
mech,
where
always
we
a
would,
mech.
yeah. And
Yep.
that's where we plug in the term insurance, because what the term insurance does, as you know, Jared, it raises what? Our death benefit.
That's right.
So that death
Or
benefit
or the
by
cost
kick,
of the insurance. Because the
exact, yeah,
vehicle we're using to complete Nelson Nash's vision is dividend paying whole life insurance,
yes,
ideally with a mutually owned company. And so as that vehicle is life insurance, we're playing inside of their rules. We're
that's
playing
right.
inside of all the rules that have been created, both IRS, government, federal government, how even the state laws deal with these various policies within the life insurance. But what we're able to, uh, I guess the best word would be make beneficial for your personal family is as these policies build value, there's a cash value component. And so that's where this when we use the term infinite banking concepts, that's what we're referring to is that you have the access to a cash value component of the death benefit. So this is a life insurance chassis with a death benefit of which it builds a, asset or a value that's the cash value component. And then that's where the infinite banking is truly stemmed from. That's just basing it down all the way to the very basic level. Would you agree with that?
I would. Yeah. Yeah. So the whole reason that it's part of the discussion is
Yep.
because people are buying the these policies so that they can build a warehouse of wealth so they
Yep.
can perform the banking function for themselves.
Yep.
And if they mech the contract, it inhibits them from doing that in a large way because of
Exactly.
yeah, because if a contract mechs, then the the actuarial or not the an accountant would say the old first in first out, first in last out. That's a very important distinction on a non-mech contract. It's first in, first out. So any monies that I put into the contract, if I remove in the form of a loan, for instance, that's not a taxable event. Whereas if it's a mech, it then becomes FIFO, first in, last out. Now, any of the gains inside the contract come out first, and those
Right.
are taxable. And
Right.
that's what happens if you mech a contract. So, very important distinction to understand.
Excellent. So the mech in itself, some other folks may use that. They may like to have it mech at a certain point. But in a infinite banking contract or an infinite banking concept style policy, the goal is to never mech a policy. If you're truly working with a practitioner, your policy should never mech.
Right. And it's interesting because the MEC equation is calculated before the contract is ever issued on the base.
That's right.
And it's also they calculate in any paid up additions, the PUA. So just because you're good to go on those first 7 years, if it's just a base contract, that contract has already met two preceding measures which are beyond the MEC. The which I don't want to get into here, but there are two other measurements that they have to take before
Yep.
they ever call it an insurance contract.
Yep.
Now, once it's authorized as an insurance contract and they look at the base contract and it doesn't MEC the first 7 years, you are good to go. Because if, let's say you have good years of dividend growth
Sure.
inside the contract, you are not going to MEC that contract. However, if you have a paid up addition attached to it, well, guess what? Every year, because they do run the MEC every single year. People
Sure.
don't realize that.
Yep.
So after year seven, if you have a paid up addition attached to a base contract, which is how you build a IBC contract, that is looked at every single year. And yes, you can MEC. Truth be told, if you have a PUA on a base contract, it will MEC every single year.
Sure.
It's an agreement between the insurance companies and the IRS and how they apply the payments under the 7702 IRS law that allows us to do these things on a tax essentially free basis if you do it correctly. I hear tax deferred. No, it's not tax deferred unless you don't and you do certain things. If you're working with an infinite banking practitioner, no. Or you've got over what was it, $12.99 million as a death benefit. This will not be taxable if
Yeah,
constructed
13999
properly.
for the estate tax.
Yes,
That's
exactly.
right.
Thank
Yep.
you. Thank
Yep.
you. Yeah, no. So if done correctly, no, it should not mech. But
Yep.
truth be told, every contract with a PUA technically will mech because there's a material change in the contract every year.
Sure.
It's only because of that agreement with the IRS, which is set in stone so far, that they will not mech.
But within
Now,
reason,
yeah,
99% of the time, you can forecast the amount of PUAs that you're going to contribute to the account or pay in
yes,
premiums over the life of the policy. And with a very high certainty, you can say that this contract will not mech. Now, there's
right.
always that one chance if you're running a razor thin line. Maybe you're running a real thin contract in terms of that base to PUA ratio. You could potentially mech the contract at no fault of your own if it really, really outperforms. But even if it did go down that path, if you were super diligent and caught it before it went down that path, you could work with the insurance company and make sure that they knew it was coming and do everything in your power to stop it.
Yeah, the problem is once the money is rolling and in place, the money that's in play, it's in play, and you
Yep.
can't do a thing about it.
Yep.
And that's a really important distinction. I'm hearing stuff out there. I've been starting to do this TikTok thing, and I'm getting all kinds of questions there. And there's some agents out there that are pushing various contracts, and they're just flat wrong. With there's some of them. These are not IBC people. These are other people, and they're saying that look, the idea is to minimize the base, maximize the PUA. You do the 1090 contracts, meaning 10% base, 90% PUA.
Yep.
Yeah, you can do that, and I've written those myself because
Sure.
I've had clients ask me to do them because they do put a boatload of cash value right up front. The problem is those things are highly susceptible to mecking later on. When you run the illustration, at ground speed zero today, they look one way, but they're going to look very different 10 years from now. We don't
Sure.
know
Sure.
what that's going to look like.
Yep.
So I do not like writing really, really thin contracts like that. I like 30, 35, 40, 50% base
I
just
mean,
to
if
give me protection from a future Mac opportunity where
that's what
you don't
Nelson
want
would have
that.
said, 40 to
Yeah.
60% base, create
Yeah.
some room for yourself and don't be afraid to capitalize.
And there's nothing wrong with a base contract. People don't
Yes.
understand it. It's not a
Yep.
bad thing.
That's
It
right.
it, it doesn't grow as much. The difference between the base and the PUA, in the early years, the PUA gives you a lot more cash value than the base does. But in the out years, man, you're supercharged with your base contract. So
That's
if
right.
you got a significant amount of base percentage in there, you're going to see very healthy growth
Given
in
that
the
we've got
later years.
a lot of airline folks that tune in for this, I
Yeah.
the comparison that I like to make on this is that your base is the size of your jet, and the PUA is the amount of jet fuel you can hold. If you have a tiny, tiny little 172, but you can hold 9,000 gallons of jet fuel, I mean, it's still not going to go very far. We understand that comparison. Whereas if you
Yes.
can put a regional jet, a medium-sized frame for the base, a nice healthy frame, and it's going to carry some decent base, but it's still not going to cross the ocean. And then you can take a jumbo jet, take a 350, and you've got this monster base. It's really true solid base that it's got as for a framework, and it'll hold a lot of fuel, and that thing will get up and stay up for a long time. So if you don't have a bigger frame, you can pack all the PUA in you want. At the end of the day, it's not going to truly benefit the user or really be the best process in our opinion.
Yeah, no, absolutely right. And I think that's an excellent example. And to dovetail into that example, if I may, think about the base as being like for the military guys out there, like the tanker. You're going halfway across the pond, you hit the tanker. Well, the tanker tops off the base. You've got all your gas you could carry in the PUA, but you've got room now to take on some more with the base rather,
Yep.
because in the early years, the lion's share of the load of the cost of assembling this contract was carried by the base. Now it's no longer there. Several years into that contract, that's gone, and there's breathing room. And so
That's
the
right.
base becomes very, very effective.
Yep.
So it just depends on when you want the cash value, but don't discount a healthy amount of base. There's too many people out there saying, I can put in 90% of your money back in cash value within, 3 years. So what? So what does that look like 10 years and 20 years down the line? We're
That's
talking
right.
about a
Look long term.
generational product, right?
That's right. Yep.
So it makes a huge difference in understanding what's working for you and what's generating the cash value.
That's right. Yep. Well, so if we take it all the way back to the beginning, we were talking about where does term apply? Why would we even talk about it in an IBC contract? And so when we're looking at building an IBC style policy, we are often going to include some version of term because the goal is to get as much cash value, or I'm sorry, to get as much premium paid by our clients so that the more premium you pay, the more cash value you have with a healthy base that helps modify that out. So again, we kind of went back to why do we even add term? And the term is to allow us to pass that 7 pay test so that your policy doesn't mech and it doesn't turn into a modified endowment contract or become a tax liability. And so if you add 7 years, let's say, of term insurance, and now you've satisfied that it's not a mech, and then you press on from there, hey, you could have a great setup there for another 20, 30, 40 years to come.
Yeah, exactly. Don't be afraid to capitalize. Don't be
Yeah,
afraid to pay. Premium is the key. People don't, it's not an expense. Premium is the source of your success in these things. Fund it and fund it early because why? The earlier you get the dollar in there, the earlier the dividend application to that dollar begins.
that's right.
So if you dump the money in at the end of the contract year, yeah, you're certainly going to capitalize on that. But now you're getting a dividend based off the average daily balance. At the end of the year, all that money's going in. It's a much lower average daily balance, and you're going to get less money. If
Yep,
you can afford it, put the money in the front end, build a bucket, have a place, a receptacle to put your money. So if you have a windfall, it's, oh, shoot, I've got 10, 20, 50 grand, whatever it is, have a place to put it. And this is the place to put it. So if you've got, you're in January and you plan for a windfall and that windfall comes in March, well, guess what? Now you have a place to put that money and immediately the dividend value begins to build
that's right.
rather than the end of the year.
That's
That's
right.
very important to understand.
Yep. Well,
So,
awesome. I know we said we'd keep it a little shorter, a little more consumable. I know this isn't a TikTok video or anything, Mr. Fancy over there, but
well, hey, a plug for the TikTok, creating tailwinds. I'm out there. I'm doing my best, Jared,
I
running with the
love it.
young kids.
I love it.
Check it
Anytime
out.
that we get to talk about this, I mean, this is not an investment. This
No,
is an ability to grow your warehouse of wealth, to build an asset that you can borrow against while it grows. I can't think of any other place where you could make that happen. I mean, maybe if you owned a Fortune 500 company and had a couple of $1 billion in stock, you could leverage that. You could do the same thing. But this allows you to do that same thing with a lot less zeros behind it, a little bit more real world.
and you don't have to run the
I love it.
company. You
And you
got you
don't
got a
have to own the
team of
company. That's
professionals
right.
behind you working it.
Yep, that's right. That's
Oh my
right.
gosh. Well, Jared, tell them to check us out on flightpathfinancial.com. Call Jared, call me. There's a contact link on the website. Check out our Creative Tailwinds podcast. It's on all of them, the Apple, the Spotify, all of them. And
Love it.
then my latest thing, and no laughing at me, Jared, I'm on TikTok doing my finest.
I
And
love
that's
it.
also creating tailwinds.
I love it. I love it. Well done. Well, thanks again for the time, John. Have a great night.
Thank
We'll
you,
talk to you
Jared.
soon.
All right. You have a great trip.
Thanks, John. Really appreciate it.
All right, Jared. You take care.
Bye bye.
Bye bye. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.